Melbourne property investors, I need your attention for the next few minutes because I'm about to show you exactly how one of our clients, Ash, turned a tight budget into a neutrally geared investment property even with a 100% loan. Now, the suburb isn't glamorous, the strategy isn't flashy, but the numbers work. And in this market, that's what matters. Let's break down everything. The purchase price, the stamp duty, the renovation costs, the rental income, and I'll show you the full cash flow calculation on screen so you can see it for yourself. So let me give you some context. Ash came to us with a budget of around $540,000. Now, if you know Melbourne, you know that doesn't exactly go far, especially if you want something that actually cash flows. The temptation with that budget is to go way out. Places like Melton, Rockbank, and those far outer western suburbs. And look, while there's nothing fundamentally wrong with those areas, we wanted to find something that wasn't quite so far from the city while still hitting those numbers. That's when we came across Sunbury and Diggers Rest. Now, I'll be honest, Diggers Rest isn't exactly an A-grade suburb. Vacancy rates are higher than we'd like, and it's still very much a growth corridor. But here's the thing. It had one key advantage that made this deal work. A property with a granny flat already partly built. That dual income potential is what turned a tight budget into a workable investment. Let's get into the actual numbers. Ash purchased a house on Welcome Road in Diggers Rest for $535,000. The purchase price of $535,000, stamp duty of $27,170, renovation and completion of $44,000, which included tree removal, led for a total all-in cost of $606,170. So the property itself costs $535,000. On top of that, Victorian stamp duty for an investor at that price comes out to $27,170. And like I said, Ash spent $44,000 on two things: removing trees on the property and finishing off the granny flat, and also putting a brand new kitchen in the house. Building a granny flat in most cases from scratch can cost you $80,000 to upwards of $150,000. Ash got this done for under $30,000 because the structure was already partly there. So like I said, the total all-in costs $606,170. Now, let's talk about the income side, because this is where the dual income strategy really earns its keep. The main house is rented out for $440 per week. The granny flat is rented out at $280 per week. That gives us a combined rental income of $770 per week, or $37,440 per year. On a purchase price of $535,000, that's a gross yield of around 7%. Try finding that on a standard house in Melbourne right now. You won't. All right, here's the part everyone wants to see. Let's run the cash flow numbers, assuming Ash has borrowed the entire purchase price, 100% loan at 6.2%, which is a reasonable rate right now. On 6.2% of $535,000, he has a loan interest of $33,170 annually, or $638 a week. He has property management fees of $2,808 annually, or $54 a week. Council rates of $1,800 annually, or $35 a week. Insurance of $1,500 annually, or $29 a week. Water rates of $800 annually, or $15 a week. And a buffer of $1,000 annually, or $19 a week. Land tax of $1,200 annually, or $23 a week. And that makes for total expenses of $42,278 or $813 a week. His rental income, as we mentioned, is $720 a week, which is $37,440 annually. He's got total expenses of $42,278 or $813 a week. And his pre-tax cash flow is negatively geared by $4,838 or $93 a week. So before tax, Ash was out of pocket about $93 a week. Now I know what you're thinking. That's not neutral. That's negative. But hang on. Remember, this is an investment property. Ash gets to claim all of those benefits against their taxable income. Plus, there's depreciation. The granny flat completion alone gives Ash a fair bit back a year in depreciation deductions, capital works on the build, plus the fixtures and fittings. At a marginal tax rate of 32.5%, those deductions translate to roughly $2,500 to $3,000 back in Ash's pocket at tax time. That brings the real after-tax costs down to somewhere between $30 and $40 per week in Melbourne. And here's the kicker. Interest rates are still expected to rise from here. Every quarter they rise. Ash pays about $25 more a week in interest, which isn't material. So what can we learn from Ash's case study? First, a dual income property is one of the best ways to make Melbourne cash flow on a budget. A single dwelling at 535 would be renting for maybe 420 to 460 a week. The granny flat adds 280 on top. That's the difference between deeply negative and close to neutral. Second, you don't always need an A-grade suburb. I mean, it's great if you've got the money. Diggers Rest isn't Essendon, it isn't Frankston, but the numbers work, and that's what matters. When you're building a portfolio on a tight budget, the numbers definitely matter. And third, look for properties where the hard work is partly done. Ash didn't build a granny flat from scratch for 100 grand. He finished one for $30,000. That saved tens of thousands of dollars and made the whole deal viable. And fourth, don't just look at today's cash flow. Factor in where rates are heading. A property that's minus 90 bucks a week today could be positive within 12 months if the rate cycle continues in the right direction or rents increase. If you found this case study useful, do me a favor, hit that subscribe button. I'm putting out regular deep dives on real deals, real numbers, and real strategies for Australian property investors. No fluff, just data. If you want us to help you find a deal like this, or you just want to chat about your situation, feel free to book a no obligation call on our website at www.propspotter.com.au. I'll see you in the next one.